Hi traders, welcome to this episode of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers, which you can briefly read through and check over, I'll just explain some of the key objectives of this webinar. We think markets are primarily driven by themes, which buyers and sellers relate to in order to enter and exit markets. These stories or narratives or market themes can be long-term fundamentals or short-term stories that increase or decrease in importance over time. So this week we'll start with how the market is shaping up ahead of the main risk event of the week, which is the Fed's annual symposium, the economic symposium at Jackson Hole in Wyoming, and Fed Chair Powell's speech on Friday. We'll then take a look at the dollar and how that's shaping up, as well as some of the other risk markets. And by that, we mean the major US stock indices, so the S&P, the Dow, and the NASDAQ. We'll also then look at review actually some of the main risk events of the past week or so, including UK data and this week's PMIs. And then check out cable, so that's sterling against dollar and euro dollar as well, and also one of its main drivers currently in euro dollar, which is gas prices, of course, and we've got quite a good chart to show that correlation, if you like. And then we'll wrap up with a preview of Jackson Hole, as well as the other main data point left on the calendar, which is the US core PCE data. That's also actually released on Friday, just before Powell's speech, actually, so may well, of course, be overshadowed by that on Friday. Our goal is to certainly to break down all the market jargon and complexities that you read about and we read about in the market. So if you do have any questions, please do ask them along the way, or certainly at the end, and we'll try and answer those as we go through the webinar, or certainly when the webinar finishes. So I just want to first look through the dollar and what's happening in markets currently. If you just bear with me 1 second, I've just got to do some fine tuning here to get the dollar chart first of all, which you can see here. So this is the DXY, obviously the widely followed dollar index, comprises 6 main currency pairs or currencies even. The euro certainly is the biggest weight in this index. We have run through this before. If you're not aware of the DXY, that's the US dollar index chart. That's a measure really of the value of the dollar against this basket of 6 currencies. The euro has around 58% or so of a weighting in this basket. Sterling around 12%, just under, I think 11.9, and then yen as well, slightly higher, 13.5% or so. Those are the 3 key currencies which make up this US dollar index, but the euro is by far the biggest. And certainly in markets this week, we've kind of seen a continuation actually of the moves we ended last week, in fact. So this wider theme where, say, last week we had double-digit UK inflation numbers, we had US retail resilience, if you like, and then we had these hawkish messages from 2 major central banks, the RBNZ and Norges Bank, which was then capped off really with an avalanche of Fed comments from officials from the FOMC that all contributed really to a refocus on inflation dynamics, and also this idea of front loading of tightening still by central banks. And that really broke ranks really with the sort of core bond stock market comeback that we've seen over the summer, really since mid-June, when actually the focus was on recessionary fears, and that would really keep central banks sidelined sooner and potentially for a bit longer as well. This week, certainly, first of all, I think Monday morning we had that news around Chinese banks cutting their loan prime rates to support the mortgage sector. And that really reminded everyone that the Chinese economy is certainly slowing. And then more recently, of course, in the last session or so this week, we've seen a more pronounced risk-off move, and that has benefited the dollar really. That, along with then this sort of pronounced expectation really that the Fed and that Chair Powell in his speech is quite hawkish on Friday. We've also then had global risk sentiment fueling really defensive trades as gas prices have spiked higher in Europe. We'll get on to a couple of those themes later, as I've said. But in general, then, once again, we sort of say to ourselves, there aren't that many alternatives out there to the US dollar. Really, the energy shock, that crisis in Europe has really hit the single currency there. If you think of the Bank of England's refusal to tighten policy, and that's kind of crippling the yen. And then you've got these growth issues in China that we've mentioned, and the kind of pretty much the implosion, if you like, of the property sector, and that's sort of hitting and weighing on some of the commodity dollar currencies as well. Near term, we should probably mention actually some data actually this week out of the US. Quite instructive, really, the price action that we saw yesterday after US PMIs. That's the Purchasing Managers survey. They unexpectedly turned out to have quite a big intraday market impact, in fact, because traditionally they don't carry that much weight, say, with the main focus really on monthly ISM surveys. And we did see a significant setback in the August US services PMI yesterday, 44.1, I think it was, against 47.3 from last month and 49.8 expected. And that was a 27-month low, and really temporarily, at least, it stopped the US dollar rally that we've been seeing. And also gave some minor intraday relief to US Treasuries. This was also then followed by a massive drop really in US home sales, which fell to the lowest level since 2016. And I think we need to remember that a downturn in home sales is often can be viewed as a leading indicator for a rise in unemployment in the US. So the dollar here, we can see technicals. We have the weekly chart here, and this push really last week, and then obviously this week into the highs. Probably best actually if we look firstly on the daily. You can see the push or prices really holding around trendline support there from that April low. We dipped just below there, that you can see. Trendline support sort of down to sort of low, or low below 105 actually, sort of 104.60 area. We didn't stay there for too long, a couple of days only. So that trend line support really is held quite well. And then the light blue line is the 50-day SMA, the 50-day simple moving average, which has held prices quite nicely over this year, really, and so acted as decent support, the 50-day moving average for the DXY. Again, kind of in line with that trend line support, touch a couple of days through that area, and then a strong rebound that we've seen in the last week or so. We got up to 109.27, I think, as the high yesterday. There you can see that. So very close to that 109.29 level from mid-July, which is obviously a multi-decade highs really in the dollar. And then we just slightly pulled back after this this run higher, really not unexpected really. When you get to the high, that you get a reaction. And we were slightly, as you can see on the RSI here, getting towards overbought territory slightly. For other risk markets, I've mentioned the S&P, for example, and also then we're looking at probably the NASDAQ. On the S&P, the stock markets in general, they registered actually weekly declines, which ended this 4-week stretch of gains. You can see here below this sort of little chart here has up and down weeks, so the green being up weeks. You can see that 4 consecutive weeks of gains, and then now this slight downturn. Last week, actually, the S&P and both the NASDAQ, they recorded their worst weekly performance since early July. And certainly this focus on Jackson Hole has had an impact in this potential Fed pushback against a pivot inflation coming under control, with expectations obviously tighter monetary policy. And Monday actually saw the steepest drop in the S&P in more than 2 months. And yesterday was the 3rd straight day of losses that you can see there. Just switching back actually to the weekly on the S&P. We didn't get quite as far as the 50-week SMA at 4335. You can see the light blue line there, but we did actually touch the descending trend line and resistance from the January top, you can see there. So that acted as quite strong resistance then, and we've obviously moved down. We've fallen below this fib level, this long-term fib level. If you look at these fib levels that I've drawn on, so the long-term fib level 23.6 from the all-time high, and then the pandemic low, the 23.6 levels at 4198. So we've moved down below that, and then also this light grey line is the 100-week moving average, and that comes at 4160. And so those levels really are resistance, near-term resistance to the move lower that we've seen. On the daily, don't want to get too complicated here. I've drawn on some more fib levels actually just for this year's high, and then the low seen in June. And really you can see, well, firstly you can see the black line here is a 200-day moving average, a widely watched level, widely watched momentum indicator. That's really key, and that comes in now at 4315 and is obvious major resistance, and that tallies pretty much with that trend line, falling trend line from the January highs you can see there. So that capped the upside. Really the upside, we got to 4325, and then obviously have fallen. We've fallen below the midpoint then of that January to June move. That midpoint's at the halfway point there at 4211. So again, probably initial resistance to any rebound potential. And then I've drawn in just that June swing high, which is around 41. Where do I have it? 4177, you can see, and then also then the February low around 4114. So some levels to look out for near term. You've got the 100-day moving average at 4085, just below that February low as well, potentially if we do move lower. So some interesting levels here. For the NASDAQ 100, you can see, again, drawn some fib levels, just some nearer term fib levels actually from the March to June move. You've got the 200-day moving average. We didn't quite get there on the NASDAQ at 13964, so that potentially caps upside. The high actually was 13720, you can see drawn in there, and then we've fallen down. I've actually drawn in a sort of bearish channel, a long-term bearish channel from the highs in January. You can see this grey area here, kind of series of lower lows, if you like. We punched slightly above there, but are now back in it, and we get the 100-day moving average below then at 12724 on the NASDAQ 100 as first support, and then the 50-day moving average, that's at 12367 if we do move lower. Some of the fib levels as well correspond to that 12652, the 38.2 retracement level, near-term retracement level as well, potentially acting as support there. Just quickly as well, we should look at the Dow Jones, which is here. Again, some fib levels drawn out. We did go above the 200-day moving average there at 33,827, the high at 34,281, but now we drop below that, and also that halfway move of the January to June move. That's at 33,302 on the Dow. So that's initial resistance, if you like, which tallies really with the highs seen in June. Support below is at the 100-day moving average we see at 32,573, and then the fib level at 32,441 if we do get this move lower potentially. Okay, next up we have, I think it's good to review some of the data. And we did get UK data actually last week, a barrage as we normally get mid-month, which included the jobs data on Tuesday, the CPI data Wednesday, and then retail sales on Friday. Sorry, I'm just pulling up the cable chart here, actually GBP against the US dollar. So just to recap briefly, headline inflation that hit double digits, the highest in decades, 10.1%, the highest actually since 1980, I think, above the 9.8% expected. And for the month-on-month reading, that was plus 0.6%, so higher than the plus 0.4% expected. Core inflation, so that strips out some of the more volatile elements, that also beat expectations. That hit 6.2 against 5.9 expected, 5.8 in June it was, and that matched the cycle high from back in April. A lot of that surprise traced back to the huge 2.2% month-on-month increase in food prices. That's in the case of the headline CPI, and then the sizable increase in various housing costs as well in the case of the core. Going forward, I think headline inflation looks set to dip actually below 10%, primarily due to this the fall in average petrol and diesel prices around 7%, I think that is, and that came out too late really to affect those July figures. But that's kind of a temporary reprieve really, because we get these this huge increase in household energy, the cap, which is on its way in October. I think that's actually announced on Friday, 75% increase expected. And while it's not actually totally clear yet how the ONS, how the Office for National Statistics in the US, in the UK, sorry, will treat some of the government discounts for bills, the increase in electricity and gas costs, well, that's expected to take inflation above 12% later this year. In fact, the Bank of England, they have a forecast of inflation peaking at above 13% for this autumn. And interestingly, I think you had Citibank out, so a big US investment bank. One of their strategists predicted inflation rising to 18.6%, I think it was, in January, basically because of rising electricity, gas prices, and the impact on inflation in the UK. So money markets, they're pointing to expectations for the Bank of England to raise rates by around, I think, 2.2 percentage points by the end of May next year, and that's up from predictions of around 1.6% from the middle of this month. And interestingly, since the UK data actually, and this is probably the key, one of the key reasons for focusing on that data, really interestingly, just how price action works. And what we're seeing now in sterling, really, as I said, since UK CPI data rose above expectations into double digits, sterling has actually slipped. It slips around over 1% versus the dollar, even as more aggressive interest rate rises are priced in. And if you think about it, higher interest rates tend to normally boost the country's currency as they support foreign investment and demand for that currency relative to those from countries with lower rates. But as I said, since the data, sterling is certainly down against the dollar, various reasons, but we've had these interest rate rises increasingly priced in. And if you look further out, sterling is actually down over 10% versus the dollar this year. It's actually down just under 1% versus the euro, and that's obviously despite the ECB only raising rates out of negative territory in July. Really, of course, the issue is then the UK's really grim outlook, if you like. The Bank of England forecasting the UK will enter soon 5 quarters of recession, and that decline in GDP obviously theoretically lowers the appeal of the pound relative to other countries. So yeah, when trading the sterling GBP, traders really, markets now are looking at the growth outlook rather than the rates outlook, if you like. Questions kind of being raised about the UK's longer term economic health, and that's of course to do with near term the cost of living crisis in the UK. And even if there's more government fiscal spending to fight that cost of living crisis, then obviously that increases UK's borrowing, and then potentially that drags further on the pound. So technically, on a technical analysis basis, sterling, obviously we're in a long-term downtrend. Last week, if you cast your minds back, cable tested key support really around the 120 area there. That was the early August low, and also this kind of double top low of this little pattern here. So the measured the bearish trend and momentum signals really pointed to lower prices, and the measured move, if we did break that 120 area, was around 117. And certainly then when we broke the mid-June low at 119.33, we've now broke through that, of course, and then we broke through that previous mid-July low at 117.59. Yeah, we've made new lows. We made a low at 117.41 on Monday, and then yesterday the low at 117.16. So beating that July low, 117.59, and there's really not too much on the charts actually before it potentially, if we do break decisively lower, probably on the Friday, so a weekly close, if we do get below sort of 117, then really 115, that 115 area is being called as a potential target. There's, as I said, not a lot of meaningful support between here and that level. The March 2020 flash crash low actually was below 115, 114 area potentially. Otherwise, that 117 area holds, and then the key resistance above we see is 119.33, which is that mid-June low, which potentially holds prices which are still generally looking very bearish. Probably worth looking as well at euro sterling, in fact, that you can see here. Interesting chart, not doing a great deal, but really this is, if you think about it on a fundamental basis, it's the lesser of two evils, isn't it? It's the economies that are really in the midst of economic quagmires, I think it's been described as. Essentially, it's a case of which of the two currencies look least bad, really. Both are down over 12%, I think, against the dollar themselves on a year-to-date basis. And really, now we're trading around that 200-day moving average, the black line there for euro sterling. That's at 84.33. We're bang on it, actually, at the moment. The 50-day and 100-day above there, capping potential upside. And then we have this sort of 83.39 level, the August lows potentially as support. So interesting to see where that goes. As I said, the lesser of two evils, if you like. Okay, I think it's worth having a look just briefly at the data from this week for the Eurozone, especially that was came in the form of the Eurozone PMIs, the Purchasing Managers Index. That this tracks basically business activity in a region, and it's the benchmark survey of businesses and companies, and really the composite had already dropped below 50. You can see on the chart here, below 50 in July, just below to 49.9. That was a 17-month low, and certainly below 50 denotes contraction. And the latest reading then that we got this week, that fell again to 49.2. So as I said, anything under 50 indicates fall in business activity. So really the survey is hinting at contraction that started in the third quarter. And really the color in the survey really shows us weakness that is also pretty grim reading. The manufacturing PMI, so the output manufacturing PMI, that ticked up a bit in August, but still remains deep in contraction territory at 46.5. I think new orders continue to fall and inventory buildup is very strong, and that really reflects a squeeze in demand that the Eurozone economy is currently experiencing. And then for services PMI, they fell rapidly in August to a level really indicating stagnation, just above 50. They dropped to 50.2. Demand also weakened for the services sector as post-pandemic rebound in consumer spending is fading as well. In amongst the surveys, in amongst the PMIs, kind of some good news from the inflation side. So while high costs continue to play a major role in weakening demand, the pace of inflation seems to be fading slightly among manufacturers and in the services sector. That, though, is down to, we should say, weaker demand and easing in input prices. So really the question is whether that can last whilst natural gas prices are reaching new records again. And if I mentioned a chart which we like, which really shows this, these natural gas prices in Europe keep on rising, and this is showing in the orange actually euro dollar, which has been inverted. So as prices go lower, this chart potentially goes higher, euro dollar goes higher. Yes, so as we mentioned, the single driver really for the euro at the moment is European gas prices, and we saw significant strength in those last week. I think the main the TTF that rallied by almost 19% over that period, and strength is actually likely potentially to continue. This week we've seen prices up slightly after Gazprom basically announced that flows along the Nord Stream pipeline will come to a halt because there is some unscheduled maintenance due to be carried out in the last 3 days of, well, August, 31st of August through to September the 2nd. And this is a real concern for the market, as it's whether the question marks over whether flows will resume after this period, really. Gazprom has said that once the work is complete, then flows will return to the 20% of capacity, which would actually be unchanged from the current levels. But really, it's this huge uncertainty and increasingly anxious state that markets are getting in about how Russian flows really will evolve as we move closer to the next heating season and obviously the winter months in Europe. The PMIs we've mentioned, they were obviously pretty bad, expected pretty bad though, is probably the point, and that kind of gave a minor lift to euro dollar prices, in fact, and we'll just check out the chart here just to show you what's been happening with euro dollar for sure. Let me just grab the chart here so you can see the euro dollar chart. As I say, the PMI data, we've gone through that. It was just interestingly, sort of not as bad as expected, really, and that gave the euro a minor lift, if you like. But of course, there are still major recession fears amid these rising energy costs. So for the technicals, euro dollar parity is obviously that huge headline grabber, if you like. There has been some speculation that ECB speakers this week may have got more hawkish and talk about the chances of more aggressive rate hikes to potentially try and offer some support to the single currency, really. And markets are still pricing in just over 50 basis points, I think, for the September 8 meeting. Yeah, so technical wise, you can see we broke through that previous mid-July low at 99.52. The new low actually below 99.98. 99 was that low. And you have to actually go back to 2002 actually in levels below 99 where we are then limited to kind of round numbers actually, so 00 and sort of the 50s below 99. If I just show you that on the monthly, go right back to here. Yeah, 02 is where we're sort of heading now. Levels around 98 really, down towards 96 possibly. Interesting, we're oversold on these longer term charts on the monthly, and also been oversold for quite some time really on the weekly chart as well. If we now drop down to the daily, we're heading into oversold territory, not oversold hugely really. So potentially, again, the weekly close is key. Below 99 does look as though we get more downside. And really, we would need to go probably to the figure and above, back into this zone, if you like, to certainly slow this long-term downtrend that you can see there. Okay, where should we go now? Let's go to the other main data point before we get on to Jackson Hole. The other main data point is, of course, Friday's US PCE data, which I will just show you here. Really, yes, core PCE data is on Friday. Sorry, it's the personal consumption expenditures data is expected to have cooled from that jump that you can see on this chart to 1% in June. That was the most since September 2005, that jump. So really quite a historical jump there. But as I say, prices really and the index is expected to have cooled in July. Following on from that big jump, really following the lower than expected CPI data and the unexpected drop in producer prices. And this is largely down to lower petrol prices. And so hoping for the core PCE, that strips out volatile food and energy prices to have increased to only 0.3% from a monthly gain of 0.6% previously, and the annualized core PCE is seen falling to 4.5% from 4.8% in June. The headline, certainly we've seen some big moves this year due to, of course, the volatile energy, food prices, and obviously made worse by the Ukraine conflict. So US core PCE out on Friday, 1:30 UK time. We also get July consumer spending numbers. They're expected to be okay. Lower gas prices really boosting household spending power and really supporting consumption elsewhere. We also get today actually US durable goods data, and that's expected to hold up despite tighter financial market conditions. So on to the focal point, of course, for this week, which is the Jackson Hole conference. That's really where central bank heavyweights, if you like, I think ECB President Lagarde and also Bank of England Governor Bailey are expected to attend. And of course, a lot of Fed officials as well as the Fed Chair Powell. But they gather from today through to Saturday. It's an annual symposium, annual conference conference held in Wyoming, and really the venue and occasion has been used in the past to signal major policy shifts, and it's sometimes actually felt as though it's been an unofficial, if you like, an unofficial policy meeting for the Fed. As I said, Fed Chair Powell's speech, that is a keynote address on the economic outlook, which he is due to give on Friday, I believe at 3 p.m. UK time. And really, the Fed is in a slight bind at the moment, as risk assets and stocks have obviously screamed higher through the summer, and that's despite Fed warnings that expectations of a peak in inflation and the so-called dovish pivot from the Fed actually may potentially be slightly premature. So many are expecting Powell to push back against that, against the market's optimism, and potentially be quite hawkish, emphasizing the battle against inflation is still foremost really in the minds of policymakers, and especially then reminding investors as well that there is another inflation report and also a non-farm payroll report before the Fed's meeting in September the 21st, that is, and really then upcoming rate decisions will potentially depend on that incoming data, and he may well remind markets of that. Of course, any questions around or any answers really to questions around how big future rate hikes will be going forward will be key, of course, and then also any details potentially on the Fed's reduction of its $9 trillion balance sheet. That's known as quantitative tightening. And is the reduction in the Fed's balance sheet. That really has the potential for volatility due to market liquidity being impacted. The Fed is due to ramp up this reduction to $95 billion actually in securities rolling off per month as they mature. And I've just got a chart up here which shows you previous intraday moves on the S&P, two Jackson Hole speeches historically. Interestingly, sort of negative reactions have been the majority of the moves, and then potentially we last year, if you remember, actually it was Fed Chair Powell talking about price pressures being transitory, so potentially there's quite a bit of pressure. The spotlight is on central bankers at the moment due to their slight misreading of their inflation mandate, their inflation remit potentially, and there being more pressure from politicians, especially say in the UK, for example, the potential next Prime Minister really putting pressure on the Bank of England, and potentially there's also pressure then on Fed Chair Powell in his speech and how he sees the economic outlook going forward. Just to touch on also the chart we do like to pull up, which is the CME Fed Watch tool. Many of you will know if you've tuned in that we like to look at this. This is the pricing for Fed funds futures and what they're pricing in for the respective Fed meetings going forward. So the September, November, December meetings you can see there. And really, so as we said, a focal point, and interestingly now a coin toss really for either a 50 basis point move, which would take rates to 2.75 to 3%, or 3% to 3.25% would be a 75 basis point move, another jumbo size rate hike. Really still a coin toss, really. Interestingly enough, that sort of oscillated between sort of 60-40, even 70-30, and then 30-70 and back and forth over the last few weeks. And now as we head into this meeting and the conference, and we head into Powell's speech on Friday, now as we said, 50-50 for a 50 basis point move or a 75 basis point move in September. If we look to December then, kind of the Fed is seen as probably relatively quite comfortable with what the market is pricing in actually towards the end of the year. So another 125 basis points of hikes to the sort of 3.5% target range. What potentially could be vulnerable is repricing higher, which would affect then the 40 basis points of cuts that are priced in for the second half of 2023, so next year. And I think we think really if we do get the Fed pushback, either by hyping bigger rate hikes, so a 75 basis point increase for September, or through its balance sheet even, so quantitative tightening and perhaps hinting that the pace of QT could be sped up, even potentially with more active sales of bonds instead of this current passive roll-off that we're getting, then stocks and risk markets will sell off further, and that adds then potential fuel to the dollar rally and it challenging that high above 109 on the DXY. As we've seen recently, the Fed is quite keen to counter the notions of this 2023 pivot. So really there is a lot to play for, you'd like to think. With this speech, we don't want to hype it up too much, and in fact the moves that we saw in the dollar, sort of that easing that we saw, really some strategists saying it was a buy the rumor, sell the fact type of move because the dollar had moved so strongly. But obviously we pulled back since those PMI, the PMI data, and then also some of the new home sales as well, affecting the dollar, especially in that intraday move. So a lot to play for, as we say, and a lot to look forward to in the coming days for sure, and potentially a lot of volatility. Okay, we'll wrap it up there. We hope you've enjoyed this webinar, and please tune in to us with the next one in a couple of weeks' time. Okay, take care, and all the best trading out there.